Party started. Welcome, everyone. We are thrilled to have you here and excited to have two special guests, Matthias Smith, who's the founder and president of Pioneer Capital Advisory, and then Ian LaClair, who is now the president and owner, CEO and owner for sure, of Hudson Monuments. And we all actually had the joy of working on a transaction together. It was joyful mostly with plenty of wrinkles along the way. Actually, not caused by any of the people on this call, but caused by external circumstances. And we are excited to share with you how a searcher, Ian, leveraged debt and equity to buy a business and all of the adventures that unfolded along the way. And our hope is that this is practical stories and insights that will be helpful for you on your own business buying journey. And just cannot say enough good things about Matthias and Ian. We invested equity in Ian's transaction, and we worked with Matthias and Pioneer Capital Advisory on a number of transactions, and just could not be bigger fans of them and their approach. Matthias is a force of nature, and we are thrilled to recommend him to any and all searchers. But we will kick off. We have some content to share with you, and then we will have plenty of time for Q&A at the end. There is a Q&A function in Zoom. It's sort of probably along your bottom bar on the screen that says Q&A. You can put questions in there whenever you'd like. Like if you have something in the middle, feel free to put it in, and then you won't forget it. But we'll mostly just do questions at the end, and we'll just jump in without any further ado. So quick agenda, just to put it on the table, is that we're going to talk about buyer readiness. We're going to talk about lending, liquidity constraints. We're talking about equity's role in a transaction. And then Ian is going to share about his case study and the business that he bought. So with that, we'll start out, and then Q&A. With that, we'll start out on the SBA side, and I'll turn it over to Matthias.
Yeah, Grant, first and foremost, appreciate you having me on here. My partner in crime, Valerie, was looking forward to joining this too, but unfortunately had a funeral. But yeah, so I guess just to kind of kick things off, so I'm Matthias Smith, founder and owner of Pioneer Capital Advisory. We are a commercial loan brokerage firm that's focused on helping acquisition entrepreneurs with going through the SBA financing process. Historically speaking, we've only been doing SBA transactions. More recently, we've started doing non-SBA. But just to give an overview here of this slide in the six-step process, essentially we start working with buyers like Ian at the point in time that they're at or close to the LOI phase. And so what that looks like from a high level is we'll sign an engagement letter with the buyer that acknowledges that myself and my team are going to help them go through the whole SBA process from start to finish. And so that includes building a credit deck that explains the composition of the acquisition, the buyer's background, an overview of the business, why the two ultimately make sense to each other, a debt service coverage overview, a source and use overview. And so that's kind of all outlined in the engagement letter. Once that gets signed, we collect a refundable good faith deposit of $2,500 that comes back following closing, or if we can't ultimately get the buyer approved, that's purely just to weed out tire kickers, which unfortunately we've had the opportunity to work with there. Once the engagement letter gets signed and once the good faith deposit gets sent, at that point, we'll send an intake list of everything that we need to build the deck that includes the financials for the business, business tax returns, interim financial statements, financials for the buyer, so personal financial statement, tax returns, resume, broker listing. And then at that point, once we've collected all of those items, one of our analysts will build the credit deck that we use to pitch the deal to the banks that we ultimately think it's a good fit for. That's used to get term sheets from the banks. The term sheets are then presented to you as a client. You would decide which one that you want to engage with. And then from that point forward, our head of closing operations works in conjunction with Valerie, who's our chief operating officer, to essentially help you navigate from the start of the underwriting process all the way through to closing. And so we're involved very closely with you through this whole process to make sure things go well, whether it's a monkey wrench being tossed by the bank to you, an underwriting requests that are coming up that just don't make sense. For example, say you're buying an agency business and you're getting asked to provide a 10-year lease. things of that nature will kind of help with navigating through. And then the post-approval closing side, helping to figure out what's the most efficient and pragmatic way to block and tackle that list of items that you get from the bank. And so one thing that we actually do at Pioneer is we bring lots of the post-approval closing process into underwriting based on the schematics of the deal that you were working on so that you can ultimately close faster once you get approved. So that kind of covers most of this slide, Grant. So from kind of a buyer readiness standpoint, when you as a business buyer acquisition entrepreneur are looking at a specific deal that you're looking to buy, there are four kind of critical things that many of these SBA lenders really kind of focus on, of many others too, but I'd say these are the four most important ones. The first one is the cash flow of the business that you're buying. So banks, being the ones extending the loan, ultimately want you to succeed. They want to get paid back so that things go well. And so the debt service coverage, essentially how much free cash flow there is after paying the SBA and making payments on the seller note, that's the most important factor. The minimum SBA requirement is 1.15, meaning having 15% cash flow over and above the SBA loan payments. At Pioneer, we won't take on deals that have below 1.25 debt coverage because we want you to ultimately succeed as the acquisition entrepreneur after closing. Most banks in the current environment have recently tightened up requirements. And so banks that historically were at 1.25 might now be at 1.4 and similar. And so what we encourage you as a buyer to do is to really think about how much free cash flow do you want there to be after debt service so that you feel optimistic about the J curve and things of that nature post acquisition. So the second factor of importance here is what transferable experience do you as a buyer bring to the deal? Have you led a team? Have you managed people? Do you come from the industry that you're buying in? Those are factors that the bank really wants to underwrite because if you think about it conceptually, you're the exogenous variable really coming into the mix here. So you have a business that's been running at steady state with the current seller. And so to the degree that you can help the bank solve for in their mind how they're thinking about you running this company post-acquisition and knowing that you're a good risk to underwrite, that's super important when the bank is looking at the deal. And so whatever you have that you can bring to the deal, whether it's, you've managed a team and led people, you're coming from the industry directly, which is rare in this specific space, those factors are all ones that you want to highlight in the business plan that ultimately goes to the bank. Another factor which has been historically easier to solve for before the SBA guidelines change is business licensing. So when you're buying a company, especially one that has a business licensing requirement, the question that the bank is going to ask you is who's going to qualify this license and how is that game plan going to work? So different industries have different requirements where sometimes the qualifier has to be an owner of the business. Sometimes it doesn't have to be an owner. But more recently, after the SBA guidelines change, back in June of last year, banks really want to either see the qualifier being an owner of the company or being a key employee where there is some way to attach that person to the business so that they basically are going to continue on post-acquisition and not create licensing risk if they end up leaving. And then lastly here is personal liquidity. And so what that is specifically is how much cash you have before making your portion of the down payment for the business acquisition. And then after you've made the portion of the down payment coming from yourself as the buyer, how much you're going to have left on the sidelines. And so one thing that we've seen at Pioneer from time to time is folks that we're working with are kind of thinking about all the cash and liquidity that they have pre-acquisition as their liquidity bucket. But the bank wants to see, after you make the portion of the down payment coming from yourselves, what are you going to have left over to make mortgage payments, car payments, rent payments, things like that? And or if there's turbulence in the business, and you have to infuse and kind of put more cash into the company to stabilize things, do you financially have the wherewithal to do that? So back, kind of going back here in time to the 2020, 2021 era, around kind of the high time of when search fund lending was taking place, um, lots of these deals were ultimately underwritten when the prime index, which is the index rate that banks use for pricing SBA loans, was an all-time low. So prime was at 3.25% during that era. And so this specifically, Kevin, this slide is talking about how are banks looking at deals, or what kind of happened with deals due to the J curve and due to the prime rate increasing. And so in the 2023, 2024 era, when prime all of a sudden went to 8.5%, what ended up happening was deals that were underwritten kind of at a razor thin edge debt service coverage ratio at 1.15, 1.2 ultimately got hosed from just not being able to make their loan payments. So if you kind of underwrote historically at that level and the business didn't end up growing to be able to keep up with the higher interest rates, a lot of these companies unfortunately went underwater. And so one of the byproducts of this, well, a couple different byproducts. One has been the tightening up of what banks want to see from a debt service coverage ratio perspective. So some banks, after having some of these defaults, increase their debt service coverage ratios to 1.25, 1.4, in some cases 1.5. Kev, as a secondary byproduct of this, from what I've seen at least, is the personal liquidity requirements have increased. And also the leverage that banks are sitting has gone down. And so this has kind of been an unfortunate chapter of the SBA history books, if you'll use that analogy, where, interest rates are low, people are optimistic, banks get excited, but no one really plans for rates to skyrocket like they did. And so kind of going forward, how this is applicable is that most banks are now more conservative. Leverage has gone down. They want higher debt service coverage ratios, and they want to see that you as the buyer ultimately have more liquidity, both going into the transaction, post-transaction, and if you're partnering with an equity provider like Grant's awesome team at Entrepreneurial Capital, that you're not depleting your personal balance sheet too much. So this slide here is kind of about some of the different challenges that buyers face going into the deal process and into underwriting. So one of them is when you're buying a business from a seller, the seller ultimately is not going to be keen to kind of give you a complete look under the hood before signing the LOI. And this is going to be the same if you're buying an on-market business versus if you're buying an off-market business. And so ultimately, especially when you're dealing with a broker, you have another filter between you and the seller. And so there's only so much that you can really learn about this company before you get into the operational due diligence and you kind of start turning over stones. And so that in and of itself kind of presents both a risk and a complicating factor because you can only really get into the weeds so much until you're further along and ultimately running the company. A second thing that we've seen is that many buyers that aren't necessarily coming from the finance, consulting, private equity world, or the business world as a whole, they don't necessarily understand the market norms with what investors want to see when you're raising equity for a deal. And so sometimes what happens too is buyers will put these deals under LOI before having extensive conversations to know that the terms that they're offering just aren't market and or the business that they're pursuing. Let's say that there's lots of CapEx expense, it's project-based revenue, it's in an undesirable industry, maybe one with stroke of the pen risk, with the government kind of being a key counterparty. Buyers really need to kind of do their diligence to figure out, is the company that they're planning to buy one that investors are going to be keen on if they are planning to have a good amount of the down payment come from investor equity. A third kind of prong here is understanding how to tell the story of both the business and your background as a buyer in conjunction to the bank. And so ultimately, there are kind of two different gates that you need to pass at the bank lending side, sometimes three. The first is getting the lender or the loan officer comfortable with issuing the financing proposal. And so the financing proposal is essentially the document that you're working towards getting approved that sets the terms and conditions for the approval subject to going through full underwriting. And so once you get the loan proposal from the bank, you go into underwriting. If things go well with the underwriting, then you ultimately get approved. And so you have to kind of figure out, how do you message the story of both your background, this business, why the two make sense for each other, and really being able to portray this well to the lender to get them on board with issuing that loan proposal, and then the underwriter with issuing the approval. Generally speaking, both the underwriter and the lender have different incentives. And so there are different kind of ways to pitch each of them. Typically, the lender is more big picture. The underwriter will kind of go more into the numbers. But understanding kind of how to message to both of those parties is very important with getting to an approval. And that's something that we at Pioneer help you with. Lastly here, from a time frame standpoint, unfortunately, anything dealing with the government is rarely fast. We wish it was. Kind of using the DMV as an analogy here, you go in and you pick a ticket, and then hopefully you get into their queue. Lots of these SBA deals, pretty average process. If you're doing an acquisition without any commercial real estate involved, you're looking at about an 8 to 10 week process, and you have multiple work streams going from legal, equity raise, lending, business insurance. If there's a business valuation involved, you have that going too. But you have a seller on the other side of this where you need to be careful about giving them too much of a peek into the hood so that they don't get overwhelmed with all these different work streams. But you also want them to be informed on what's going on from a high level. And so really trying to level set expectations as far as letting them know that this isn't going to be a super fast process and there's different steps along the way is important. And then anytime issues come up, whether it's from the lending side or otherwise, trying to find a way to convey confidence to them, but letting them know what to expect as far as how long it will take to get to a closing. So this slide here, kind of talking through a couple different reasons on why we've seen deals break down Pioneer for acquisitions. So one is financial due diligence, unfortunately not going as planned. And so this kind of happens due to a variety of reasons, but one is the financials for the taxes not matching interims. Sometimes there's a big difference between cash versus accrual. Lots of times there can just be other surprises that come up in the quality of earnings report that aren't shared kind of before you go into LOI. Sometimes the broker inflates earnings to make the deal look more palatable. The second reason here is the business valuation coming in below the purchase price. And so similar to when you're buying a property and you're getting financing on it, you have to get an appraisal. With SBA financing, one of the requirements is getting a third-party business valuation when you're buying a company. And so the SBA doesn't allow banks to lend over and above the valuation figure. And so when there's a delta between the two, you have to bridge the gap with a combination of seller financing and cash equity. And even though that's allowable, some banks are so fixed on the valuation for the company that they aren't big on wanting buyers to do that, because then they look at it as you essentially overpaying. And so to the degree that you're able to really determine going into the LOI process that you're paying a market multiple is super important. And that's something too, where when you're raising equity and you're talking to investors like Grant's team, lots of investors will really spot check the multiple because the return on investor equity, that's one of the factors that kind of plays in there. When you're overpaying, it's harder to get the same returns. So business valuation is super critical. Thirdly, here is on the equity raise side, back to trying to figure out when to start having conversations with investors. When you, as a buyer, are signing an LOI, if it's contingent on raising investor equity and you ultimately can't get that equity raise done, that can make your deal fall apart. And so, if you don't have the means to put in all the capital on your own and you haven't really kind of had those conversations pre signing the LOI, just kind of keep in the back of your mind that that can ultimately be a risk factor that unfortunately can kill your deal, even if you get it approved by the SBA lender. Fourthly, here is sometimes surprises just come up on these deals in underwriting. So I've sometimes seen before where financials get worse from the time the underwriting process kicks off to the time you're further along. I've seen before where buyers put together a lackluster business plan that doesn't do a good job to explain the transition. They don't really sell their story to the bank in a way that the bank, the lender, and the underwriter can understand what they bring to the deal. And both of those items, in conjunction with surprises that come up, those can ultimately end up leading to decline. Sometimes what's happened, kind of going to the fifth point here, is a big macro circumstance can present itself while you're in underwriting with the bank. So back to April of last year, when we had the tariffs that got announced, a lot of deals that were prone to those having a negative impact on the P&L statement of the company they were buying, where those deals were in underwriting. Unfortunately, the banks kind of pulled the rug and said, we just don't feel comfortable. There's too much uncertainty in the broader macroeconomy with not knowing how these tariffs are going to settle out on the financials of the companies that are being financed with this lending. And some of those deals ultimately got declined due to that.
Thanks, Class. That was awesome. And a quick question that I will ask now, and maybe everyone knows, but how much does it cost to work with you guys, ultimately, assuming a transaction closes?
Yeah, great question, Grant. So we ultimately get paid by the bank. So other than the refundable deposit, which comes back following closing, or if we can't get the buyer approved, we don't cost anything to work with.
This is why we so heavily recommend Matthias and his team to everyone, because it does not cost money, and it helps you a lot throughout the process, and probably ends up saving you meaningful money. Um, I'm just gonna quickly share a couple things, and then we're gonna turn it over to Ian, who will be far more interesting than me. But as Matthias has alluded, the ways that equity investors can help is helping you reach and ideally exceed the SBA's 10% equity requirement. So 10% of the purchase price, with some weird exceptions sometimes, but basically 10% of the purchase price has to be equity cash at closing. Our view, just as an aside, is that 10% is too little. You would not normally buy a house with a 10% down payment. You'd have to pay PMI for that. And our view is that it is much riskier to buy a house with 90% leverage than to buy real estate with 90% leverage. And so we strongly recommend people consider 15% their like absolute minimum, and that higher is often better. One, because it makes the bank underwriting process much easier. Two, because it makes it much easier to survive the J curve process post close, which the vast majority of businesses experience. And three, because there are just all kinds of problems that appear right after you buy a business, and 100% of those problems cost money in our experience. And so it's just nice to have additional money on the balance sheet. The second thing, similar to Matthias, is that we have seen hundreds and hundreds of deals, and so can be helpful if you're considering an LOI or you're in the LOI process and trying to negotiate. If something seems like it's an attractive opportunity from a deal price and structure perspective, if it's a sort of a middle of the road opportunity, if it's an unattractive opportunity, we will tell you what we think, because we have money on the line. We will vote with our dollars whether or not we think it's a good deal. And capable searchers use that as sort of feedback, and really capable searchers use that as leverage when they're negotiating with sellers. We are always happy to be the bad guy and for you to say like, look, sorry, I just can't get investors, or there's no way I'm going to be able to get the bank to approve this structure, but can we do this other structure that sort of protects against more of the downside? Both equity investors and the bank are most concerned with downside prevention, where they don't want to lose their money first. And then their assumption is if they don't lose money and it's a good person buying a good business, the upside will probably take care of itself. But the downside is what they're most concerned about protecting. The bank, even more so, but investors, equity investors of all types as well. And then, just as mentioned, you really, in our view, you really, really, really want to have meaningful cash on the balance sheet at close that is above and beyond whatever the working capital that maybe is included in the deal by the sellers. And hopefully you've been able to negotiate that, but we'd say include extra capital beyond that. We're working on a transaction right now that's larger, but they're deliberately putting $1 million of capital on the balance sheet at close, in addition to millions of dollars of working capital being provided. It's a larger business, but that's still a meaningful percentage of the purchase price. And it just dramatically reduces the risk profile for everyone. And you as the searcher, you are taking the personal guarantee. You have the most downside of everyone. Frankly, more downside than the bank. They have the other side of the guarantee, which is wonderful. Investors can lose their money, but they can only go to zero. You can go past zero. And so we just always say, for the love of all that is good, put extra money on the balance sheet, which you will control and you can use to protect your own interests post close, to protect yourself from a J curve or a potential loan default situation.
One comment just to add in is the benefit of having equity investors as well is with SBA loans, the bank has 25 cents of credit risk on the loan, where if it defaults, essentially they're getting paid 75 cents on the dollar from the SBA. But with equity investors, they get completely wiped out if you default. And so they tend to be more conservative than the banks from what I've seen. So you get a more critical set of eyes over and above than what you're going to get from the lender.
Yeah, it is free consulting, and we will vote with the most valuable currency possible, which is our own money. So yeah, we're happy to provide perspectives, and yeah, that's literally our whole reason for being. I'm just going to quickly share what we look for in deals and in searchers to give you a sense of how we think about risk mitigation and opportunity maximization, and then we'll turn it over to Ian. So for us, we'd say businesses north of $750,000 of SDE are much more attractive. It's more likely to be sort of a real business and less likely to be just a job, effectively. Less than a 5 times purchase multiple. We think that small businesses, unless it's the most unique circumstance of all time, should not cost more than 5 times earnings. They are inherently risky. You're taking, a meaningful bet on yourself, and we think that if someone were to be buying something with pure equity, it should take them less than 5 years to pay themselves back, and that's what a 5 times multiple basically is. The other qualitative things that we really care about and think about and encourage you to think about are customer concentration. I've run small businesses that I've started for the last 10 years and invested in lots of transactions. And almost always, if you have a big customer, you're going to lose them in the first year post-close. It's hilarious how often it happens. And we'd say, do your analysis with that as your go-in assumption. Just assume you're going to lose the biggest customer. And if the biggest customer is 5% of revenue, it's probably not a big deal. If the biggest customer is 50% of revenue, you're probably dead. And so we would steer away from those types of situations. CapEx, which is something Matthias mentioned as well, is that some businesses are very capital efficient, like a marketing agency. You probably get paid in advance, you deliver the work, you pay your team 2 weeks in arrears, beautifully capital efficient. If you are renting industrial forklifts, you have to buy the forklifts, you're probably renting them to customers, they're probably paying you 30 days later. If you want to grow, you need to buy more forklifts. And so that just makes it very difficult to have cash for problems that you might encounter. And we'd always caution you against using EBITDA as a metric in any situation where there is real depreciation expense, like a forklifts business, for example. EBITDA is fake. If there's real depreciation, you cannot deduct the real costs of depreciation because you will end up paying for it in cash. And then recession resistance. You're taking a 7-year SBA loan. And so I would personally be unwilling to bet that there will not be a recession sometime in the next decade. And we want you to be able to survive that. Ian's business, which you'll hear more about, is a beautiful example of demand uncorrelated with economic cycles. And then in terms of searchers, obviously owner operator committed to operating. For us, like independent sponsor type things where they're going to buy a business and then sort of put someone else in is not our cup of tea. There's a book by Patrick Lencioni called like Humble or the values it talks about are humble, hungry, and smart, which is basically what this is. You'll get to meet Ian, but like Ian checks all these boxes to a T and then some. Ian is incredible. Um, and then in a perfect world, someone who has a clear why and knows what they're looking for and knows why they're looking for it and why they think that they would be potentially a great fit for that specific opportunity. Operating industry experience is a plus. And if you don't have that, which not everyone always has, at least having transferable skills. Things that we look for from an equity investor perspective. Um, and with that, I'm going to turn it over to Ian, who is the owner of Hudson Monuments. And Ian, maybe you just want to introduce yourself and then share more about your transaction.
Absolutely. Thanks, Grant. Appreciate all the accolades. Good to be here with you and Matthias, who are the dream team on my deal. So I am the owner of Hudson Monuments. We are a full suite granite memorial sales and service business. So we do a lot of types of monuments, but our bread and butter is headstones, gravestones. And so we not only design, engrave, and install them, but we also do some on-site cemetery lettering. So if you think about adding a date to an existing gravestone when a family member might pass, we are the ones in the cemetery doing that on-site work as well. Um, so I started searching for a small business to buy about a year and a half ago. And at that point, I was coming up on 7 years at IBM. I was in a consulting and corporate strategy capacity. And I was feeling a little bit lost. I wasn't feeling motivated, spinning my wheels a bit, thinking about what was going to be next. I stumbled across the concept of a search fund and immediately fell in love with the idea of acquiring and operating a small business. I was really looking for more autonomy, the ability to do real work with real people, and real tangible work. I think coming from a very digital, remote-based corporate job, I was looking to really pivot to the opposite end of the spectrum. I had always enjoyed getting my hands dirty with some more blue-collar jobs growing up, and I felt like that paired with my business acumen from the corporate world prepared me nicely for this sort of search. So I set out on a geographically constrained search. Was looking in an hour and 15 minute of where I live in Boston. Um, and I was doing a proprietary and brokered search. So as you guys likely are reaching out to the brokers every week, checking all the biz buy sells. But I was also writing handwritten letters and cold calling and getting the boots to the ground to try and find a deal on my own. I didn't have a industry focus per se, since as we know, when you're looking to stay relatively close to home, you can't be picky with that. But my general thesis was I wanted to be in an industry that was a need rather than a want, something that wasn't recession, um, we'll call it, impacted. And I think when I look at all the businesses that I got close on, you'll see a pattern that they were generally dirtier businesses that a lot of people wouldn't want to do. And I saw a lot of opportunity in that space. So looked at things ranging from oil tank removal to asbestos and mold remediation, to where I am now in what you would consider to be the death care industry. Um, so the search took about a year. Ultimately found Hudson Monuments in June of last year, and it took me about It took 3 weeks to go from a signed LOI, excuse me, a verbally agreed upon LOI to a signed LOI. And then I wrote it down here somewhere. Where are we? It took me 4.5 months, a full 4.5 months to get from LOI to close. So it was quite the hairy closing process. But before we dive into that, I want to talk about the deal structure. So this one was a bit of a beast. Not only was it a much larger deal than I set out for, we did max out the SBA limit. It had a real estate component. So this was technically two legal entities, because one business line was a separate entity, two parcels of real estate. And as I said, a rather large deal, maxing out the full $5 million of SBA debt. And I think just one of the reasons why Grant and Matthias were so impactful in this deal was this was a larger deal than I set out to buy. And so I needed investor equity and I needed the help and guidance of an experienced loan broker to help me, someone with a rather limited personal net worth and personal liquidity, in order to pull that off. So when I initially met Matthias, I think looking back at my emails before this call, it was nearly 2 years ago. I'm surprised he didn't consider me the boy who cried wolf, because I was so close on 3 or 4 transactions where he really helped me put the deal structure together and gauge viability. But he was really instrumental in all of this. I think just Matthias's ability to get on a call at all hours of the day, throughout my closing process, as we'll get into. He would jump on calls with the broker with me to calm him down and provide confidence in my ability to close. And really was a bit of a therapist at many points in the deal, for me, making sure, and confirming, that the deal was going to close. And then likewise, Grant was tremendous as well. I think I met him, I think 6 months before coming to him with this deal on another one. And so I was really excited to be able to partner with him on the equity investment, just because he was such a good guy to talk to on my first go around and such an optimistic, thoughtful investor. So before I dive into how they really helped, I think I just leave it with Grant and Matthias, Pioneer and Entrepreneurial Capital, were both paramount in the deal. They were incredibly responsive, which I think uh, is vital in any M&A transaction. And you got to be able to take advantage of that. So if I were to give advice when working with them, they'd probably like that you over communicate. And with that, I mean, if there's a problem throughout the deal, give Matthias the call to let him know something's going on the debt side. If there's a problem in the deal, give Grant a call to update him so he knows with the timeline as well. So diving more into closing the transaction, as I said, it took 4.5 months from LOI to close. There was a laundry list of issues. At times, it felt like if something could go wrong, it was going wrong. Just to name a few, we had a opposing counsel, the seller's lawyer, who was dead set on killing the deal, it seems. He had not done an SBA deal before. He wanted to be in control of the process, and was rather convinced that I was not qualified to close. So overcoming that hurdle was a constant battle throughout the process. Um, there was the government shutdown, as Grant alluded to, towards the tail end, where all we needed was the SBA number, and the government was shut down, and we were unable to get that. So that caused a tremendous amount of stress with the seller relationship, where we had to, again, over communicate on what was going on and our expected resolution, without scaring them as well. Some other issues we had, the real estate component, as I mentioned, we had an appraisal, of course, required when you are using an SBA 7A loan, to buy a parcel of real estate. and the purchase price of the deal was contingent on that real estate. So we had lots of drama around the ultimate purchase price of the real estate, given the appraisal came in a little bit low compared to what the seller was asking for the business. Um, at times, our environmental and Alta survey reviews were blocked by seller's counsel. As you may know, you need to get an environmental review to buy a piece of real estate with an SBA loan, no exceptions. Um, Towards the tail end of the deal, the lawyer tried to stop us from signing the subordination agreement on the seller note, which is critical to be signed in order to close the deal. So can get more into these specific challenges, but it was a hairy closing process. And I think when you are in a process such as mine, it is extra important to have the right capital partners in your corner. All right, so what I really want to spend the time on here is some of my lessons learned and takeaways. My broadest piece of advice that would span across the whole process from search through close would be to just work with good people. And it sounds cliche, but you don't get to pick your seller's counsel, as I was constantly reminded. You don't get to pick the broker on your deal, but you do get to choose your deal team and your capital partners. So take advantage of that and be thoughtful with who you work with. I think the term partner gets thrown around a lot, but you can't use that word lightly here. I mean, you are entering into a long-term relationship with the bank that Matthias is going to pair you with and with Grant, who is your equity partner on the deal, should you choose to work with them. So really think about who you want to be in that relationship with. And then you can't forget the seller. I mean, the seller's relationship, your relationship with the seller is critical. I would probably a conversation for another time, but I would argue that if you were looking at two deals with the same characteristics, and one had a seller you liked, but was a turn of EBITDA more expensive, that I would go with that deal over the same deal with a seller who you might not get along with. It is just so important post close, and you don't realize how important it is until post close to have a good relationship there. So to just dive more into the investor partnership here, I think the great thing about how the ETA landscape has evolved is that when you have a good deal and you have, or you can demonstrate a good business buyer fit, the money is there. The money will follow. And so that means that you, as the searcher, as the operator, will likely have options as to who you should partner with and who you should take investment from. So I think choose carefully. I think there's a lot of trust involved on both ends. There's obviously an enormous amount of trust for Entrepreneurial Capital for Grant to invest in you. They want to make sure that you're going to be a good steward of their investment, but you need to trust that who you're taking money from will have that money at the end of the day and who will stand by their commitment. When Entrepreneurial Capital says we're going to invest in your deal, they're going to follow through on that. I don't know if you can always say the same about taking money from Uncle Joe or your college roommate who might not have that reputation or that experience investing in deals like this. Some final words of advice on taking money from investors would be, I would do it from folks who have searched before. Grant and Julia have both been searchers. And a mentor once told me, only take investment from someone you feel comfortable going to with bad news. There's probably going to be bad news at some point. And so make sure you're comfortable having those conversations with whoever you work with. I think the next thing I'd say is in this era of ETA where there is so much information ranging from this webinar to the podcasts and the articles, even the X content, you got to be prepared both in the research that you're doing ahead of time and having your deal team in place for when the time comes. So that might look like really knowing what goes into a good business plan before you even write your business plan. That means if you're coming into a transaction where there's a license involved. For me, I needed a hoisting license, which is essentially a crane operator license. I approached the bank saying, I know the license I need. I've already registered for the course that I need to take before I take the exam. These are the exam dates. These are how many chances I have to take that exam before we close. And should I, for some reason, not pass the exam, here are the steps we'd take in order for this to still work. That's just an example of how you need to have that foresight and that proactive research done before you start talking to a lender. And then finally, when we think about preparation, I thought I knew everything there was to know about a business acquisition coming into this. And for the most part, I was pretty well prepared, but I never intended to buy real estate with my deal. And looking back, I had done the least legwork and prep work on the real estate component, and that caused the most headaches, right? So just another example of how that preparation is really critical. Though I will say the real estate, although it complicates the deal, is a really powerful tool. Um, I didn't mention this in the deal structure before, but I had a blended term. I have a 14-year term on my loan. And if you don't know, the business component, 10-year term, real estate component, 25-year term. So when you blend the two together, depending on how much the real estate is, how much the business is, you get that blended term. In my case, it was 14 years, and that was tremendously important in stretching out my loan term and my payments. Um, Last note on deal structure, which I failed to mention, was the seller note I have is on full standby, and we'll get into that in a bit here. I had a full standby 14-year note for 10% of the purchase price, which sounds a little crazy, but was immensely important as we got to the closing table. Um, Next, I would say low liquidity raises the bar tremendously. I think don't let it stop you from searching, but be prepared for more hurdles and more risk. It means you're going to have fewer options for lenders. Um, I didn't have as many choices as someone who might have a different profile or balance sheet than I did. I think tactically, if you're still search curious and not already with a deal, spend some time thinking about allocating more maybe towards your search cash fund and less towards your retirement accounts. That might be a trade-off you need to make. If you're already in the search, I think my tactical advice would be don't be afraid to take on more investors, to take on more investor funds than you might have originally planned. Bring more equity to the deal to strengthen that deal, even if it means owning less of the company. And then I'd be remiss if I didn't double down on the working capital point that Grant shared earlier. I think Grant encouraged me to bring a little bit more. I brought $50,000 more to the table in working capital that I'd initially planned. And guess what? It's a really good thing that I did because I didn't misgauge the working capital dynamics in my deal. In fact, I think I got them right. But working capital isn't just about your operating working capital post close. And it's not just about unexpected things that pop up post close. It can also be about at close. In my case, as I mentioned, we had maxed out the SBA limit. We had unexpected deal fees that came in higher than we'd projected at the closing table. That's not a huge deal when you have more room in the SBA debt limit to play with. You just increase your loan a little bit. I couldn't increase the loan. It had been maxed out. So that extra working capital I had went to our deal fees. So just an example of how working capital is critical, an example of how Grant's guidance was meaningful here. And overcapitalize your deal when you can. You'll never hear anyone say otherwise.
Thanks,
And,
Andy.
yeah.
Oh,
And
no,
then
no, keep going. Yeah.
and then finally on the liquidity point here, I think Matthias is really good about laying out your options as it comes to creative deal structures. And those structures have evolved over the years here as SBA regulations have changed. I mentioned I had a full standby note. Technically, that counts as equity in the eyes of the SBA. So in theory, I could have brought only 5% equity to my deal. I think when you're a low liquidity buyer and you're hearing about these creative structures like that, you think that's the golden ticket. That's the way that I'm going to get this deal done. But I think these creative deal structures, for example, the full standby seller notes, shouldn't really be about how can I put the minimum amount of equity in this deal. It should be about how can I best strengthen my profile. So in my case, that meant bringing more than 10% in equity, even though the note meant I could bring five. So let's call it my 11 or 12% of equity paired with that 5% full standby note. In the eyes of my lender, I had actually brought 17 or 18% equity. That was one of the ways that I was able to pull this deal off as someone who didn't have the balance sheet that many banks should be looking for. And so I think my final point here, which wraps everything together, is that credibility is everything throughout this process, ranging from establishing that credibility with your equity investors, but then really most importantly for me was credibility with the broker, the seller's lawyer, the bank, and the seller himself. So as a searcher at all, kind of the deck stacked against you, right? Compared to a financial or a strategic buyer, let alone a buyer who's younger, is lower net worth, no direct industry experience. The deck is really stacked against you. So establishing credibility is really, really important in getting your deal done. And I think working with Matthias and Grant was that extra bit of credibility that I needed to pull this off. If you think about a given deal a broker may look at these days or post these days, they can afford to disqualify candidates right off the bat because they deem them not credible. Brokers want surety in close. And so my broker was constantly nervous about my ability to close. I would have Matthias on calls with me to make that credibility clear. I had Grant provide me with a letter of support early on saying, yes, he has the financial viability to close this deal. And then as we got even deeper into the weeds, actually had to provide me with some proof of funds documents in order to pull this off. So those aren't golden tickets per se, but they help develop your credible buyer profile so that seller's lawyer who might not be familiar with this, a tough broker, and the bank all view you as a credible, prepared, and ready buyer. So across the board, I would say partner with good people, be thoughtful about who you partner with, be proactive and prepared coming into the closing process, and make sure you have the right capital partners, particularly when you have a complex deal like mine, a tough closing process, and you might not be as well capitalized as others.
Thanks, Ian. That was fantastic. That's fantastic. And thanks, Matthias, as well. We're going to try and clip through some of these questions. And thanks, Matthias, for answering some of them in typing. But I'll just sort of go randomly. A quick one for you, Ian. Did you find the business on market or proprietary?
This was on market. I think again, if you only have a limited amount of time to search per week, I was a part-time searcher. I was employed while searching. Highest bang for your buck is going to be that brokered deal pipeline.
Love it. Love it. A quick one here from anonymous attendee. Talk about sources of cash for balance sheet at closing. This basically comes from uh, equity capital, essentially, either yourself or someone else, or potentially like really creative negotiation with the seller on the working capital peg. But those are typically the sources. Um, Let's see. What are you seeing in market for post-deal liquidity for the buyers? Matthias, you've mentioned this in the chat, but maybe if you just want to voice over it as well. And I'm sorry, I think you might be muted.
Yeah, it looks like I'm on mute. Sorry. Generally speaking, I would say like 3 to 6 months of personal expenses is a pretty good spot to be, but it varies heavily from one bank to the next, which I know is not a helpful answer, but it's just the current reality.
Yeah, it is a wide range. And if you check out Matthias's answer in the Q&A, some thoughts there as well. But yeah, it's remarkable how bank specific it is. Um, And then we've questioned basically someone who it sounds like their current liquidity is more constrained, but they have potential visibility into future liquidity from investments they've made having exit outcomes. And so just trying to think through how a bank or other partners might think about that. And maybe Matthias, you want to comment on that one as well?
Yeah, so for someone like that, what I would say, Grant, is as long as they can bring a portion of the capital stack or the down payment themselves to the transaction, maybe it's 5 to 10% kind of bank dependent, and they have enough post close liquidity left to get the bank comfortable, I feel like that could be fine. But it really depends on if they're going to be able to check the box to show they're bringing enough to the deal to make the bank comfortable themselves, and then they'll have enough left over after the fact.
Love it. And maybe a related question here. How important is personal liquidity if the business's existing cash flows will more than cover expenses and debt servicing costs?
Yeah, so if that's the case, generally speaking, I'd say most banks are fine kind of downscaling on the post close liquidity. If there's kind of excess cash flow, where you could start pulling, enough distributions and kind of salary day one after closing.
And basically, Matthias, my sense has been that if you have a really high debt service coverage ratio, maybe some of the other areas there's more flexibility, but if you have a lower debt service coverage ratio, they're viewing your post-close liquidity as a fallback point for the business to experience some distress.
Correct. Yeah, yeah. It's very much like a teeter totter dynamic where it's like higher debt service coverage, lower post close liquidity, and then the opposite as well.
And then for Ian, if you were working when you were you were working when you're going through deals, how did you think about when to make the jump to leaving the W-2 during diligence? And were you able to do diligence while employed?
Yeah, I was in a unique situation. I was working fully remote. I don't know if I would have been able to do this if I was not fully remote. I think the diligence is the easy part because diligence can be done at all times of day, right? It can be midnight and you can be looking at a sim. The hard part is being available for broker calls and visits, et cetera. That would be the challenge that I would see if you're trying to do this and you're in an office 9 to 5. As far as when I wanted to really burn the boat, so to speak, with the W-2, my plan was always to do it, once the deal had closed, really pushing it towards the end. And like, it's a good thing I did because if you had said signs purchase agreement and then the government had shut down, you could have been in a period of a holding pattern for weeks on end with no income, and that's not great when you're already coming from a point of lower liquidity, using a lot of your personal funds for the closing costs and for your equity injections. So I would say if you are in a remote job, it is going to be a lot of long nights and a lot of hard work, but very much feasible. If you're currently employed in the office every day, that's going to be a challenge. People have done it, but you're going to have to get creative.
What one
Yeah.
comment to just to add in is for anyone that's keeping their W-2 while they're searching, which I personally advocate for, I would try to kick the ball down the road as far as possible before quitting your job because in the current economy, it's just there's all time uncertainty due to these changes with like AI, Anthropic, Claude, all these variables. So hold on to your W-2 for as long as you can because if the deal dies, it might be hard to go back in the workforce.
I think we have perfectly answered all the questions right before the hour. So thank you everyone for joining us. If you have other questions, feel free to reach out to, I think, any of the three of us. Not to volunteer you guys, but it sounds like maybe you're open for chatting with people. We will circulate a recording and the slides via email after this to everyone who registered. And if you somehow got in here without registering and you don't get the slides, just send me a LinkedIn message and we will get them to you. But thanks again to Matthias. Thanks again to Ian. It was such a joy working with both of these guys on their transactions. And yeah, thanks for being here. I hope everyone has a great weekend. Take care.
Take care.
Thanks,
Thanks.
everyone.